Welcome back to the deep dive. Today we're jumping into something really key for anyone trying to figure out their finances. Understanding your personal investing style. Think of it maybe less like just picking songs for a road trip playlist,
Yeah.
and more like actually designing the car itself for your journey. The right investments, much like choosing the right engine or suspension, they really depend on your unique financial vibe, your specific goals, and, this is crucial, how much market turbulence you're actually okay with handling. This deep dive uses some really insightful material, basically giving you the blueprints to map out your own financial journey. We're going to cover defining goals, figuring out your comfort with risk, and looking at different investment styles. And we'll use some real-world examples to make it all click.
Exactly. And that's the mission, right? What's often missed, and honestly it's fascinating, is that lining up your investments with who you are isn't just about feeling comfortable. It actually helps fight those common behavioral traps, the biases that can trip up even savvy investors. It's less about chasing whatever stock is hot this week.
Yeah, the noise.
Right. Much more about dodging those psychological pitfalls by, understanding yourself first.
Okay, with that in mind, let's talk about setting up our financial GPS, defining those goals. Why is having that destination so important before you even start investing? What happens if you don't?
Oh, it's absolutely critical. Not just for direction, but for sticking with it. Think about it if you jump in a car with no idea where you're going.
You just wander around.
Totally. And you'd probably quit at the first sign of trouble, right? Research actually shows that writing down specific measurable goals, like, say, I want $50,000 for a house down payment in Walnut Creek by 2030, makes you something like 42% more likely to actually get there. It's like your constant North Star, which, makes you wonder, are your financial dreams written down somewhere?
Wow, 42%. So writing it down isn't just like a nice idea. It's a real Kickstarter for action. Our sources have a great example for this. Sarah, she's a 30-year-old teacher in Seattle. She didn't just vaguely hope to buy a condo. No, she set a clear target, buy one by 2028, wrote it down, and then broke it down into monthly savings goals. Really practical.
And look what happened. Sarah, because she had that clear target guiding her, she invested in a mix of stocks and bonds. That consistent focus, that sort of psychological anchor of having the plan on paper, it helped her hit her $60,000 down payment goal a whole year early.
A year early.
Yeah, it just proves how powerful having that clear objective can be for your discipline.
And that links into the time frame, right? How long you have to reach the goal changes the strategy. So for short-term goals, maybe 1 to 3 years out, you're mostly thinking about keeping your money safe.
Exactly. Capital preservation is key there. You'd lean towards safer things like bonds or maybe high-yield savings accounts. Their lower volatility means your money is more likely to be there when you need it without, a sudden market drop messing things up.
Okay. And then for medium term, say 3 to 10 years.
Yeah. For that range, a mix usually works well. Some stocks for growth potential, some bonds for stability. You've got a bit more time to ride out smaller bumps.
And the really long-term stuff, like retirement, 10 years or more down the road.
That's where you can generally afford to take on more risk. Think growth stocks, maybe other riskier assets. Because you have that long runway, decades even, to recover from market swings and hopefully capture better long-term growth.
Got it. So that time frame really dictates the risk level.
Absolutely. Tying it all together, those clearly defined goals are what make financial dreams real. They give you the structure for your investment choices, sure, but also for that steady focus, you need to ignore the market noise and avoid emotional decisions.
Speaking of ignoring noise and handling swings, let's shift to risk tolerance. We often use the roller coaster analogy here. Some people love the biggest, fastest, wildest rides.
The adrenaline junkies?
Yeah. And others, well, they prefer something much smoother, a nice scenic tour, maybe a gentle incline.
That's a perfect analogy. Risk tolerance is really about how comfortable you are with the idea of losing money, potentially.
Yeah.
And it's not just one thing. It's shaped by your age, your financial situation, stable income, lots of expenses, debt, and of course those goals we just talked about.
Right. And you see this play out differently for different people. Let's take Alex. He's 25, works in tech, solid income, no real debt. He's got time on his side, so he can afford to take bigger risks. Maybe invest in growth stocks like Tesla, knowing he's got decades to recover if things dip.
A long horizon changes everything.
Compare that to Linda. She's 65, retired. Her main goal now is making her savings last and generating income. So she's probably looking at more stable dividend-paying stocks, maybe like AT&T, to get that steady cash flow and preserve her capital.
Exactly. Priorities shift. And that leads to a really crucial point. Your risk tolerance isn't fixed for life. It changes. Big life events, getting a new job, getting married, having kids, even just entering a new life stage. These should all trigger a little check-in, a reassessment.
To make sure your portfolio still fits.
Precisely. Because being in investments that are too risky for your current comfort level, that can lead to serious stress, maybe even panic selling when the market drops.
Which just locks in loss.
Right. So finding that balance is key. And what's really interesting, it's not just about the numbers on a page. It's also about digging deep and asking yourself, honestly, how would you feel if you woke up tomorrow and your portfolio was down 20%?
Oof. Yeah, that's a tough question, but a necessary one. People often focus on the upside and kind of forget the emotional roller coaster downside. It forces you to be real about your comfort zone. Our sources mention things like risk tolerance questionnaires, which can be helpful.
They can be a starting point.
But they also stress that just reflecting honestly on how you'd react in the real world is just as important. You need a portfolio that lets you sleep at night.
Could agree more. Sleep is important.
Okay, so we've set our GPS with goals. We've figured out our preferred roller coaster ride with risk tolerance. Now let's get into the different strategies, the actual flavors of investment styles, if you will. This is where it gets really interesting.
It does. Each style has its own vibe, its own approach. Understanding them helps you see what might fit you. Let's start with growth investing. What's the core idea here?
Are these the investors looking for the next big thing, the treasure hunters, seeking companies that are going to grow super fast?
That's it, exactly. Growth investors are focused on companies expected to outpace the general market. These companies often plow their profits back into the business for more expansion rather than paying out dividends. Think NVIDIA, huge in AI chips right now. Or maybe Mercado Libre, the big e-commerce player in Latin America.
Right, companies with big potential.
Huge potential, yes, but also higher risk and more volatility. You saw NVIDIA's massive surge recently. That's the potential upside. But it can swing the other way, too. So this style really fits investors with a high tolerance for risk and a long time horizon to ride out those swings.
Okay, opposite end, maybe. Value investing. More patient.
Definitely more patient. Value investing is like being a careful bargain shopper in the stock market. You're looking for good, solid companies whose stock price seems lower than what the company's actually worth, its intrinsic value.
The Warren Buffett approach.
He's the icon, absolutely. Buying great companies like Coca-Cola or American Express when they seemed undervalued. Value investors look at metrics like the PE ratio, price to earnings, basically. What are you paying for each dollar of profit? Or PB, price to book, comparing market price to the company's assets. For example, Morningstar flagged Pfizer as potentially undervalued in 2025 because they had a strong pipeline of drugs, even if the market wasn't fully appreciating it then.
So it takes research.
A lot of research and patience. You have to be careful not to fall into value traps, stocks that look cheap but are cheap for a good reason, like fundamental problems.
Got it. What about income investing? The name sounds pretty straightforward.
It is. Think of it like planting a fruit tree that gives you regular harvests. The main goal is generating a steady stream of cash flow. This could be through dividends from stocks, interest from bonds, stuff like that.
Who is this typically for? Retirees.
Often retirees, yeah, or anyone else who needs reliable passive income. Think of established companies, maybe like Johnson & Johnson or Home Depot. They have long histories of paying dividends. Home Depot, for instance, had around a 2.9% dividend yield in 2025. That's a steady income stream, really helpful for retirement funds. It prioritizes stability over, shooting for the moon growth, generally lower risk.
Makes sense. Okay, next up, passive investing. The set it and forget it approach, like cruise control.
That's a great way to put it. Passive investing usually means buying index funds or ETFs, exchange-traded funds, like, say, the Vanguard S&P 500 ETF. The goal isn't to beat the market. It's to match the performance of a broad market index, like the S&P 500.
Why do people choose this?
Well, the core idea is that consistently beating the market is really, really hard, especially over the long run, so why try? Plus, it's usually low cost, it's very transparent, you know exactly what you own, and it tends to be pretty tax efficient because you're not buying and selling constantly. If you'd put $10,000 in an S&P 500 ETF 10 years ago, you likely would have seen some nice, steady growth with almost no effort.
So you trade the chance of huge gains for simplicity and market return.
Pretty much. You accept the market average, which historically has been pretty good over time.
All right. And the last main style, active investing. This sounds like the opposite of passive, like a high-stakes chess game.
Yeah, that captures it well. Active investors, like managers at hedge funds or mini mutual funds, are constantly making decisions. Buying this, selling that. Their goal is to outperform the market benchmarks. They're actively trying to pick winners and time the market.
Does it work?
Well, some active managers definitely have periods of success, but study after study shows that most of them actually struggle to consistently beat the market over the long haul, especially after you factor in their higher fees and the costs of all that trading.
So it's tough.
It's very tough. It usually requires a lot of time, deep expertise, and probably a higher risk tolerance. It's generally better suited for really experienced investors or those who hire top-tier professionals.
Okay, wow. Growth, value, income, passive, active. That's a lot of flavors. So what does this all mean? Do you have to pick just one lane and stay in it?
That's the key question, isn't it? And thankfully, no. Most people don't stick rigidly to just one.
You can mix and match, like getting a sundae instead of just one scoop.
Yeah.
Exactly like a sundae. Blending styles is actually really common and often very effective. It lets you balance risk and reward based on your specific situation. For instance, your portfolio could hold some NVIDIA for that growth potential.
The exciting part.
Right. Maybe some Pfizer because you believe it's undervalued, bringing in that value element.
A bit of bargain hunting?
Uh-huh. And then maybe some Home Depot for that steady dividend income. So you're diversified not just across companies, but across investment styles and goals.
That makes a lot of sense. You get to chase some growth, but also have that reliable income base. It sounds truly tailored.
That's the goal, a tailored fit.
So wrapping up our deep dive today, the big takeaway seems to be that investing isn't one size fits all. It's deeply personal. Understanding your own style, which means really nailing down your goals, being honest about your risk comfort level, and then choosing from these different investment approaches, that seems like the absolute first step to success. It really is foundational. Whether you're drawn to chasing growth like with NVIDIA, patiently seeking out value like Buffett, or building stable income streams with companies like Home Depot, the key always is making sure your strategy lines up with your goals and your genuine comfort level, not someone else's.
Couldn't have said it better. Start small, stay curious, and definitely revisit your plan as your life changes, because it will. Your financial future really is an adventure, one that's definitely worth crafting carefully.
So maybe the final thought for everyone listening is, what's one small thing you can do, maybe even today, to get clearer on your own investing GPS? Or to really gauge your comfort on that financial roller coaster? Or maybe just explore one of these flavors of investing that feels like it might actually resonate with you.